Welcome to episode 34 of Kontrarian Korner. I'm Ben Kellerin. Today we have a very special guest on to talk with us about oil. It's going to be actually the first part of a series I'm doing, but I'm very excited to talk to him because he has some of the best charts I've seen on some long-term historical charts for oil, and I think it's going to be a very interesting conversation. But Rob, thanks for coming on.
Hey, thanks, Ben. Thanks for having me, and excited to talk about energy and possibly what the next decade may hold for all of us.
Yeah, so Rob has a lot of experience covering oil, energy, some of the stocks in the sector, but has been doing it for a long time. And I was thinking we could open it up maybe by drawing some parallels from where we are today to maybe a prior cycle and kind of see if we can set the table that way to kind of see where things are at as you see them.
Yeah, sure thing. So I guess a good way to start may actually be not actually slide one, but maybe talking about some of the I guess you could say long-term drivers for oil prices and why I think the energy sector could be one of the best performing sectors. Energy has turned the corner, but could also be one of the best performing sectors in the S&P 500 over the next 10 years. And I look at the oil and gas space in a much different light than many others. And I think it's because of my training and having a historical context and a historical background and the patterns that do occur. So Ben has this chart deck, and it's actually my 1Q25 slides that went out at the end of December. But it'll hopefully be included in the slide notes, and you can, reach out to him. But I think that there's, various macro drivers that drive these cycles and have been driving commodity related cycles going well back 200 years. And I have the data for it. But I think that there's two underpinnings within cycles for commodities. And number one is liquidity or excessive money creation drives these cycles. And then number two is what I would consider maybe, if you don't believe the monetarist view, is well productivity. And I think well productivity is rolling over once again, and we can touch upon all those factors in a couple of these charts. But I'll begin with this chart, which this section 2, the macro drivers, commodity cycles, and then sort of stop for Q&A and can dive deeper into the oil and gas stuff. But this is the number one chart. And what I show here, well, actually, the point of this chart, to get right to the point, is excessive money creation underpins every commodity cycle going back 200 years. And I can actually prove it going back over 800 years. But what you're looking at here in this chart, the black line is an all commodities index. It is a 10-year moving average over the year-over-year change. So it is smooth out over 10 years. And the green line is world M2, or world money supply expressed in US dollars. And what you find is that it's not just US, but governments all around the world will create an excessive amount of money in order to fight a war or deliver a social spending program that they know they can't pay for, because they know that the voting public will never, be for the sort of taxation policies. So why not just debase the currency? And that's essentially what you're looking at, is every single war, and even, these spending programs like the Great Society in the 60s, or what I would term now the energy transition, which to me is just another social spending program. And we have these wars raging around the world. Well, those drive excessive money creation, which drives commodity prices from here on out. And then if you want to get another chart, but unfortunately it's not in this pack, but if you were to look at all commodities, they all move together over the long run. Okay. So there is no substituting one for the other. They will all rise in what I consider sort of long-term commodity arbitrage. But what the other point about this chart too is that, and it's actually left off in here, is that after a point of commodity deflation or wage deflation, so ever lower prices going down, you get this rebirth of, if you know your history, populism in some way, shape, or form. And you can see here from, say, the War of 1812 to the 1820s was a period of wage and commodity deflation, and that gave rise to Jacksonian populism. And what did Andrew Jackson do? He got rid of a regulator of money. He got rid of a central bank. And then if you look at this, one of the worst periods of commodity deflation after the Civil War, from 1860s to the 1890s, if you know your history, Williams Jennings Bryan and the Cross of Gold. What was Williams Jennings Bryan? He was basically a historical figure who was backed by the silver interests, who wanted to make silver a form of money to create inflation, i.e. printing money. Okay. So these figures throughout history that give rise after these wage deflation, they're populists. And, you know, Trump's a populist. Biden was a populist, transformed. They're populists, and populists like to print money. And they don't care what regulators of money, i.e. central banks, have to think about it. They often circumvent them, get rid of them, or, as was the case in the 70s, completely suppress them. If you know your history around Arthur Burns and the central bank under Nixon, and before him, LBJ. LBJ actually was a Southern populist who was helped win the White House because he was backed by a lot of Texas oilmen. So I think we're just seeing history repeating here once again. And, you know, as far as you talk about the cycles, this is, I won't read everything on slide 12 here, but, you know, long ago, my mentor made me read a bunch to understand my history. But what I've noticed in reading various books, such as The Prize, The Seven Sisters, and, you know, a host of other around within the history of the oil industry, is that we regularly go through stages within each of these cycles, and they tend to repeat in chronological order. Now, sometimes they may overlap, but they tend to repeat, maybe with different characters, but the sort of same makeup. And what you're looking at here is each column is a separate cycle. Okay. We've had 5 before this one. We're in the 6th one, and that's on the far right. So you have your 6 cycles going all the way back to the beginning of the oil industry in the US, when Colonel Drake discovered oil in Pennsylvania. And each row is a separate stage. Okay. So different cycles, but the rows and the stages are the same. And stage 1 at the top is typically a war ends, new supply comes online, demand slows, and oil capitulates. That was after 2008. And then, because oil's low, you usually get instability in oil producing regions. And then stage 3, or row 3, there is a period of low capital spending and consolidation. What are we having right now? We're having one of the biggest consolidation waves within the E&P industry, but this is no different. Like Royal Dutch and Shell came together at this same stage over 100 plus years ago. But then after that comes stage 4, which is typically debasement of the currency. And that's what I think is coming next. And then you have a new demand hub, global conflict rises. You get, you know, this stuff around peak demand transforms back into peak supply. And then we just repeat anew. And I merely think we're in the latter stages of stage 3, transitioning to stage 4. We even had hints of it, stage 4, with what we saw with excessive money creation in response to COVID. I mean, more money was created than to fight World War II and the Marshall Plan combined to fight COVID. Voila, we had inflation. But, you know, sort of skipping forward, what I think this all means for the energy sector as a whole is that I think it can return anywhere from, I know the chart says 8 to 9, but I think I've updated this even of late. It's like 9 to 10%. Probably does anywhere from, we'll call it just, you know, to be fair, 8 to 10% per annum after inflation over the next decade. Okay, so let me repeat that again. Energy's real returns, real total returns after inflation, so that's price plus dividends, has the potential to return 8 to 10% per annum on average over the next decade. There's going to be years where we do above it, below it, but on average over the next day, I think that's what investors are looking for. And the way I show this is, let me sort of step back, as one of my favorite strategists, Louis Vincent Gav of GavCal, has this great quote. He says, "Economic activity is merely energy transformed." And I think it's a great quote because it jives with this chart, is that if you take energy's market cap, or my Crude Chronicle Energy Index market cap, divided by economic activity or nominal GDP, it's a mean reverting series. And that's what you see in this blue line. And it mean reverts anywhere from 3% along the left axis. So energy's market cap as a percent of US GDP falls to as low as 3% of GDP. And it can rise to as high as, we'll call it the low teens, 12, 13, maybe even 14% of GDP. And, Warren Buffett has this sort of a market cap as a percent of GDP. It's not as mean reverting as this, but what this tells you is it's been a great predictor, a 0.62 R square, of what real total returns will have been or will be over the next decade. So if this correlation holds, that's showing that with energy here at about 5.5%, 6% of GDP, you're probably somewhere within the neighborhood of 8 to 10%. Dividend yields being right around 3.5%. So the balance comes from price appreciation in the share. So I think it's going to be a better decade than what it has been. And rightfully so. Is that I love this chart, and this is sort of what I'm known for, I guess, within, the Twitterverse and the Substack world, is that I go through and gather a lot of historical financial data for these oil and gas companies going all the way back to the days of Standard Oil. And that's what you see right here, is you see the super majors returns on equity. So if you know your finance, it's simply just net income divided by shareholder equity, all the way back to 1882. So it shows that blue line all the way along on the left is Standard Oil Trust, but it has ExxonMobil, Chevron, Shell, Shell TNT, Royal Dutch Shell, BP, Total, and Conoco. And it also includes all of the companies that they acquired. So within ExxonMobil's Mobil, if you know your Chevron history, the old Gulf, Getty, Texaco are in there. So some pretty good history there. And then BP, you got the old Amoco and Arco and Standard Oil of Ohio. But what you tend to find, the point of this is that these cycles are never, ever, ever linear. Okay, I think that's what, if you try and think of energy in the short run, you will get frustrated. And they move up in waves. And you also see this, this sort of within inflation waves as well. But they move up in 3 waves. And I got this idea from reading work by an old Solomon technician by the name of Alan Shaw. And Alan Shaw was like a godfather in like the CMT technician world. But what he noticed is within, these mega themes, whether it was gold in the 70s, tech stocks in the 90s, the AI, NVIDIA craze now, is that you see a disbelief and then a pullback in stocks, and then a belief wave and a pullback in stocks, and then greed. Okay. And you also get the other wave on the downside, is you get a disbelief. Okay. They rally, a belief cycle, then they rally, and then utter capitulation. Well, what I show here in the green dots is I just simply rephrase his work: doubt, optimism, parabolic euphoria, or the acronym I like to use is DOPE. And I like using DOPE because, like dope, it's addicting, but at the end of the day, it's all bad for your health and destroys you. So I just think that, just like these parallels for history, is that what we saw from 2020 to 2022 was just the doubt wave. That is the reason that energy's, market cap as a percent of the S&P 500 only rose to about 3%, despite earnings rising to about 9-10%. So there's doubt in the cycle. It's done it before. If you look at energy, when it came off the 70 through 73 bottom, there was this wide disparity between its share of market cap and its share of earnings. Same thing happened in 46. The same thing happened in 1914. And the same thing happened off the 01 recession. Doubt. Okay. That's why you hear these things about peak demand. That's doubt phase. That's why you hear these things about companies not spending, they're consolidating. They doubt the cycle exists. But then you get this pullback that we've been in, and then you get the optimism waves, and that one shocks everyone. And by the optimism wave, the consensus thought And the mentality around these cycles goes back to, okay, maybe there's something here. Maybe the underinvestment thesis is correct. Maybe there's no such thing as an energy transition, and that, everything needs to share within the fossil fuel or the energy stage. And maybe this thing is expensive, and then finally you get a pullback and then parabolic euphoria. And that's when everyone's in. That's when everyone piles in. No one, there's no more doubters. What will it feel like? It'll probably feel like what the last 2 years in AI and tech have felt like. And so, if you actually look at the price action of NVIDIA over the last few years, the chart relative to the S&P 500 looks exactly like what Schlumberger looked like in the 70s.
At least until this morning.
Yeah, until this morning. So I guess I'll just wrap up with this chart, and then Ben, we can hop into some Q&A. But how do I this chart is sort of, I always consider this my the most important chart in commodities, because it was taught to me 20 years ago in a different form. But what I show here, this is oil divided by, it's really oil divided by large cap U.S. equity stocks, mostly growth stocks. But it shows oil divided by the S&P 500. And that these cycles, oil versus the S&P 500, or the way to think about this is hard assets versus paper assets, commodities versus stocks. They trade price leadership every 12 to 13 years. And we were down 12 years from June of 08 through 1Q of 2020. And we hit the bottom end of the range. And for the first time since the late 90s. And I think that we're in another growth cycle now. Yes, like the chart the last 2 years has been rough, but like you saw earlier, these things come in waves. And actually, if you look at oil versus SPX, unfortunately, you have to really squint in there, but it's starting to tick up since December, when the market's been having some of its headwinds, which are again coming to fruition again. So I think that's sort of a good place to stop, Ben, unless you have some questions, and then we can jump into it.
Yeah, I was thinking it'd be interesting to go and take a look at that, like, big picture of the cycles. Was it 6 cycles you said?
Yeah.
One of the questions I had on that was, like, is there a specific amount of time that each cycle is, like, how a length on average, or is it kind of just really depend on the specific cycle?
Yeah, I would, someone once told me the more you try and draw parallels to history, sort of the broader you should be, because that's when you make mistakes. And I know my strengths, but my strengths are also my weaknesses. So my strengths is that I know my history, but relying too much on history, especially when you try and get specific, can be a weakness. Trust me, I've done it many times. Yeah. But I think the thing that the general guiding line with here is that you can't skip over a stage. That's what I've noticed. Okay. And sometimes you'll even have shades of 2 within 3, and sometimes shades of 4 while you're in 3, but you can never go from like stage 2 to stage 5. Okay.
Yeah.
So they can be a little bit of mix and match, but generally you tend to move through these phases. So, I like this one, stage 4, is that I actually only added stage 4 maybe a year and a half ago when I began the Substack, because I started studying a lot more around the history of central banks, because I knew how important the creation of money was to a lot of these cycles and how they got kicked off. If you actually think about it, when oil was discovered in the foothills of Pennsylvania, it was at the height of the Civil War. And going back to then, the U.S. had, or I guess I should say it wasn't the U.S., the North had issued an excessive amount of greenbacks. Okay. They debased the currency. It was fiat for the first time. So prices for oil, the first recorded price of oil was $20 a barrel. Inflation adjusted, that's well over $360 a barrel, the first recorded price. Unfortunately, we've never achieved that ever since. That's why that chart, oil versus SPX, is always down. So but that's what I take away. And the fun part is that the fun parts of these cycle, at least for energy guys, maybe not everyone else, is stage 5 and 6, and we're not even there yet.
Yeah. The other question I kind of had is related to stuff going on today. It's a little bit kind of chasing headlines a little bit, but you see stuff about, there's going to be tariffs on Canadian oil, which I find highly unlikely. And everyone's talking about drill, baby, drill. Like Scott Bessent has his 3 million barrels of oil, which they quickly and quietly revised to barrels of oil equivalent. But
Right.
do you have any thoughts on some of the political changes that might or might not happen as we kind of get into Trump's second term?
Yeah, I think always to step back is, the most value I bring is sort of this chart, and Trump at the heart is a populist. Okay. And at the heart of it is he, unlike, at 2016, he's going to deliver, he has a mandate, in my opinion, deliver nominal growth. Okay. And nominal growth has an inflation component, which essentially is why you're seeing here when he first rise, what we're looking at here is oil versus the 5-year embedded inflation expectations. Now, this chart has since not been updated, but you have this much stronger correlation between the two when he first won in 2016, which was a surprise. Inflation expectations in oil started to rise and fall together once again because populism, in the form of Trump, it would have been another actor, was reborn again. Now, but to get to your, to address sort of the first topic, and this is, something I have coming up either later this week or next week, is that it's a presidential preference. Okay. I don't know of a president maybe since Eisenhower, when he imposed oil import quotas that was actually for higher prices for domestic producers. But I don't know of a president since the mid 50s that's ever wanted higher prices. They all want lower prices. But counter to his first term, there is also a material constraint, and something that is vastly shifted since he was last in the White House in 2016 is that, and I've done it, I did it, is if you go through the over 20 U.S. oil E&Ps and their proxy statements, okay, and how managements are compensated. All right. So this is their compensation structure a decade ago in 2014. So right around this period. Okay. It would blow your mind, but the average among 20 oil focused E&Ps had a weighting within their short-term annual bonus to grow production. The weighting was 30%. Okay. So there's various other metrics, but counter to that, how big do you think returns on capital were? Because returns on capital, if you know the metric, is a governor to growth. Okay.
Yeah, probably not great.
It was non-existent. It was probably less than 5%. What do you think? Just rhetorical question. What do you think the incentive metrics, the average weighting among the remaining U.S. oil focused E&Ps is on production or reserve growth today?
Today, I don't know. I'd say under 10%.
5.6. So you had 30%. Like managements were incentivized to grow. It was 30% of their short-term annual incentives, their cash bonuses, okay, that we all work for. Today it's 5%. When you exclude Hess, and Hess is unique because they have this phenomenal Guyana asset that they got to get up. When you exclude Hess, that shrinks to 3% average weighting.
Wow.
So my point is that the material constraint is that managements are not incentivized to grow like they were 10 years ago. And so, yeah, that may be nice and all, but if you know about executive compensation structures, majority of how these oil execs and just companies and CEOs, not just oil execs around the world, get compensated, it's in the long-term incentive structures, like, performance share units, restricted stock options, things like that don't vest for, say, 3-5 years, is that pretty much none of them, zero, have production or resource growth incentive structures in them. They're gone versus 10 years ago. Whereas things like returns on capital have risen from, say, 2% to 10 to 15%, sometimes in the form of ConocoPhillips, well over 40% of their long-term incentive structures. That's the material constraint. Okay.
Yeah.
So a president can say, I want more, but the oil execs are like, well, we're not incentivized to do what you want. And we won't be, because when we did that model, this happened right there, that blue line in oil. So that's the material constraint. It won't happen. It's why all of the, at the back half of 2024, all of these commentators were saying non-OPEC is going to flood the market. It didn't happen. Okay. The material constraint is still in place. Shareholders voted. Counter to that, there's also, or sort of shifting gears, there's also material constraints when it comes to tariffs. Okay. Unfortunately, I don't have a chart in this. I've done a post recently about it. Is that I don't know what he's going to do. It's an executive order, okay? Which means he can do it, he can't do it, It's his decision, but there still is a material constraint to it. Like that, I think the important part of his just Trump in general and politics or geopolitics is identifying a material constraint. And the material constraint are the Midwest swing states. And what I mean by that is Trump flipped 6 swing states in the last election. 3 of them reside or are served by PAD 2. And as you all know, if you're listening to this and know anything about energy, PAD 2 is where the majority of Canadian oil comes in via the refining sector. Those swing states were Wisconsin, Michigan, and Pennsylvania. Well, Pennsylvania is not in PAD 2, but all of its pipelines come in from PAD 2. So my point is that if in any way, shape, or form, tariffs on Canadian oil lead back to inflation, which was the number one factor since 2022 in deciding not only midterms but also elections, the Republicans will completely lose their majority in Congress in the 2026 midterms. Okay, and the other interesting thing, I was talking with Matt Gherkin over at BCA Research, is that if you look at the most contested House of Representative seats in the last election, the guys who won by 2% or less over the incumbent Democrat, there are around, I believe, 8 or 9 of them that won by 2% or less. Half of them are in the PAD 2 district or served by it. So my point is they won't get reelected. My point is that they also won't implement policy to get any sort of bill that will make it through the House. Doesn't mean he can't do it, but it does mean that he will be subject to the material constraint of it.
Interesting.
Does that make sense?
Yeah. I think it is when you kind of like basically put together the game board a little bit. Like, I just think there's so many moving pieces, but I think it's highly unlikely that he does something where like he shoots himself in the foot trying to like talk tough on tariffs or like try and get Canada to the negotiating table on whatever his agenda is. But I don't know really where you want to go from here if you want to take a look at some more of the slides, but I think it'd be interesting to talk. Like, there's a bunch of other things going on with oil, but I'd be curious to hear if there's any like sectors specifically that you're looking at you find interesting, or if there's I guess investment implications for kind of what you're looking at. But I think that'd be a good place to go.
Yeah, so I guess I have a different view and a different way of looking at oil over the long term and like where prices are going and what have you. And this was actually born out of my way of thinking about it was actually born out of frustration. When I was a young analyst during the 2000 cycle, during the China Bull EM cycle, and I was like, all right, well, oil over here on the right, this is inflation adjusted crude oil prices monthly since 1864, we just were going from 20 on our way to 148. I was like, all right, just coming out of college, let me see what the drivers of this stuff are. So if you go on Twitter or you read, various research, what you'll find is that oil has this inverse correlation to inventories, right? Inventories draw around the world, oil prices go up. So I'm like, okay, how do people determine inventories? Well, they project supply and demand, and the difference between the two leads to inventory builds or draws, right? Makes sense. Okay. Well, let me back into that. So the logic should go that when oil demand is growing faster than supply, prices should rise, right? And vice versa. Well, you can't prove that out in the data. Like I couldn't. And that was the frustrating part is I used data by EIA, IEA, OPEC. Like I just couldn't come to it. And this chart on the left took me actually like 15 years to build because you can find supply data, global supply data from various resources going all the way back, but you can't find demand. But I finally found, a source to construct global demand. And the first thing I noticed is the exact two have been the same line since the industry began in 1866. Supply always falls if demand falls, and supply will always rise to meet demand. Okay. And in fact, but yet still, despite them being the same line, we get these secular moves in oil prices and these cycles that last well over a decade, 12 to 13 years on average. And so drilling down into it is that this is the same line, just drilling down into each of the, I showed you those 5 previous cycles, and we're in the 6th one currently. This is all of them right here. This is demand versus supply growth. And what you tend to find is the lines all move together. I mean, look at this, like that 70s cycle where oil went from 10 to, over $100 a barrel. The growth rates actually decelerated, and they moved the exact same throughout the whole period. And even during the China EM cycle, demand versus supply growth was pretty much the same. But it's been nothing different. And so, when I hear these arguments about China demographics are awful and demand will fall, or, there's excess OPEC capacity, I always fall back like, well, it hasn't mattered throughout history. So what gives, like what drives these cycles is actually, I think this chart is that it's the cost of an incremental barrel, okay, to develop that drives prices over the long run. So when the cost to replace supply or develop a new source of supply, when that cost is rising, that throws a floor on which volatile crude prices are going to continually bounce off of. And the way I show that here is actually, I wasn't the first one to discover it. I discovered this, great piece of research. There's a old oil economist named Marcus Adelman, and he began his work because he wanted to debunk a lot of the peak supply theorists in the 70s. You can Google it. He has his paper here, User Cost in Oil Production, out there. And that's his orange line there, Adelman's development costs, is that when development costs started to rise, which is that orange line, you notice that inflation-adjusted oil prices, which is the bars in the background, started to rise as well. And you'll actually notice the lines tend to lead the bars by a little bit. Well, he ended his work in the early 80s, but if you are crazy enough to dig through over 60 plus oil companies' reserve disclosure data, you can reconstruct his development cost index. And that's what I did in that, light blue line. And it's the same thing. Well, the point is that development costs, or think of this as replacement costs. If an oil company produces a barrel of oil, then if they just want to run out of inventory, they have to replace it. So they have to go drill and develop new reserves and what you tend to find there is that development costs rise and fall with well productivity growth rates. And so the way I show that is this orange line, and this is the big debate in the energy world right now. I'm in the camp that well productivity is peaked, It's not the first time it's ever peaked and won't be the last. And that's driving development costs higher. Okay. And this has been going on we're coming up pretty much on the 6th year now that it's been happening. Is what I show here. This is well productivity growth for Exxon, Chevron, BP, Shell, Conoco, Oxy, Hess, Marathon, all the shale players on a 3-year smooth basis. And the bars is the same bars as the previous chart. It's development costs. So, for example, in the 1970s, when U.S. production peaked, but also OPEC took away the most productive wells in the world, it would blow your mind. I got data from Aramco. These things used to do over 6,000 BOE per day in the Middle East, in things like Safaniya and Kharais, when they first found them, and Gawar specifically. I mean, those are massive. Those are monsters. Those are the type where, in the old days, the oil shoots out of the well.
Put a straw on the ground and out pops oil.
Yeah, and then you don't light a match. That doesn't happen anymore. But, when they nationalized the most productive wells in the world, development costs started to rise. And that happened well before the events of 73 and 74. And my buddy Arjun, if you're probably listening to this, many of you probably know him over at Super Spiked. He has some great stories where he retells his old, late 90s, early 2000s experience with trying to forecast non-OPEC supply, and they would always miss. He says we would always miss the number. We were always too high. Non-OPEC was not meeting supply forecasts. Well, it's because well productivity growth peaked in 98 at the bottom of the Asia crisis, well before China ever joined the WTO. Okay. And then development costs started to rise, but then, and they're doing so again. Well productivity growth peaked in 2019 on a growth rate basis. I didn't notice. I did not say shales peaked. I said the growth rate in well productivity. So you have two choices from here. Is that and it all comes down to the answer is industry. It may not be in the Permian. It could be somewhere else. It's just going to have to drill more wells because the development costs are going up. But what happens is that development costs rise to a point where basins that were previously unproductive or not worthy of capital allocation become competitive. But then, the laws of economics take over and competitors, and we figure out ways to lower the development costs and achieve economies of scale. We have to remember shales is 20 years old. Okay. It's a manufacturing process now. And I think the days of, booming shale growth are behind us. And even if we zoom in on the epicenter of it, what we have here is, this is just the Permian. So the epicenter of non-OPEC growth, where it's been over the last decade, these are the Permian on the left here, the Permian focus pure play E&Ps. So some of them have, like Conoco will have, Alaska, they have various U.S. onshore, they have they're a diversified E&P. These are the guys who have just been in the Permian. Well, their F&D costs or their replacement costs have started to rise as well. So this is a chart I'll be updating. And so what this does is this throws the floor under oil prices for the long run until, the cycle repeats.
Interesting. So as far as like today, where we are today in the Permian, are we looking at, like, in layman's terms, like $70 a barrel for break even, or where are you kind of putting that if you had to guess?
Yeah. Let's see. Probably the best one is, this is, we'll just say within non-OPEC. Okay. So this drills down into it deeper. And if reserve accounting, which I've had to learn myself for the last 2.5 years, I've been fortunate to have some subscribers, sort of teach me the ins and outs of it. But there's within reserves. So we'll say, just for example, oil company XYZ has a billion barrel BOE equivalent, or a billion barrels of reserves, right? Some of those reserves have been developed, it's usually about 65%. That means they've sunk capital, they've sunk wells. They're pretty sure about that number that's on the books. But then some reserves are undeveloped. Just think of it as just an empty lot of acreage, okay? They haven't sunk capital into it, but they have a pretty good guesstimate of how much is in the ground, okay? And they pay reserve accountants and such to do this. Well, the most concrete figure is that PD, that proved developed reserve, okay? And that's what you're looking at here, the bars over here on the left. This is PD F&D costs, or proved developed finding and development costs. It got to as high in 2014 before the bust, before, you know, we figured out how to do shales and the productivity cycle took off, to $30 a BOE to do this, to develop non-OPEC supply. Okay. That fell to as low as $12, which is why oil in turn also fell, right? But that's been rising. That bar is at the latest is about $18 a BOE. But the cool part is if you just take the line divided by the bars, right, or the price of oil relative to the floor it bounces off of, you get this chart over here on the right. And it tends to move within these sigma bands. But that sigma band is saying that the floor on oil is about 3.2, 3.5 times $18. Makes sense? So you sort of do the math, you're getting out or somewhere around, I believe, someone correct my math, I'm wrong. I did this in my post about a month ago. It's somewhere around $62 is the floor. That's what this is saying, okay? Now, the midpoint, though, says it's 92, and the top end says it's around 120, okay? But as the bars on the left continue to rise, as well productivity continues to roll over, as we talked about previously, then the floor and the price of oil continue to rise. So this is a chart I update regularly. So, and I got pretty bullish on oil, say in October, right when a lot of negative sentiment was floating around because, you know, sort of various factors. But this was definitely one of them that we were bouncing off replacement costs.
Yeah, interesting. As far as some of the stuff I've seen, like I know people have talked about like the production per foot in the Permian has started to go down. They've kind of talked about like Russian production falling. Do you have any thoughts on like where that next field may be if we do get like a price to incentivize more drilling?
Yeah, you know, the thing about it is that I could tell you, but I'll probably be wrong. And that what you tend to find just within the history of oil, the stage 6, is that the supply, actually, excuse me, is stage 1, i.e. war ends, new supply, demand capitulates. Over here in the first row is that the supply that ended the last cycle is never the one that ends the next one. History doesn't repeat in that essence. So, you know, to tell you that, and that's also within this time, within this background, is that like it's also yes, we have the incentive structures we talked about before, but like, you know, the Permian's it's not gonna end this cycle. It's not gonna be enough. It's not gonna be sufficient. What is, I don't know. It's often very much a surprise. You know, in the 2000s, we were developing Canadian oil sands. We were developing Gulf of Mexico deep water. You had the Brazil pre-salt, but it was shales, and no one saw that happening at the time. The same thing in the 70s. Nobody knew that the extent that Alaska would have on the world. And so, you know, that it's interesting. I always keep in the back of my mind, it could be Russian production. And I say that because no country or oil producing region has made more comebacks than the Russians. If you're keeping count, they've made about 5 throughout history. There were 2 revolutions before the revolution in 1907, and each time, you know, production would fall and come roaring back to pay for it. And it typically comes roaring back to pay for internal strife or a civil war. In the 90s, it came roaring back after the breakup of the Soviet Union. So, it could be the price spoiler again. But I don't know, I don't know, but I'll be tracking it hopefully still.
Yeah. No, it's interesting. You mentioned some of the offshore production there, like in Brazil and Gulf of Mexico. I know one of the slides you had was showing kind of the consolidation of offshore oil services, and
Yeah.
that's been a sector of interest for me for at least a year now. But I'd be curious to hear your thoughts on like what it might look like for the next several years for deep water versus jackups versus
Yeah.
OSVs, if you have any view on all those.
Yeah, it's definitely my offshore content gets a lot of more play on Twitter. I think there's like this silent following out there in the social media world. And it's like me in high school. Like a guidance counselor said, Rob, you're always gonna have a lot of potential. And so the thing about offshore is that I could build remember what I talked about, that the cycle is dope, doubt, optimism, parabolic euphoria, is that offshore's best years are in that final third stage, the offshore drillers. But the setup, the long-term setup is, I think that there's probably some better areas between now and then for your capital. And especially, trying to get someone into the oil and gas space, you don't want to get them into, the offshore industry fully, and where it can completely rip your face off in a quarter. But the bull case is that if you look at exploration expenditures, inflation adjusted since 1956, we've never been as low, which is why utilization rates here are bouncing around, say 60%, as low as they were after the 80s oils bust. And there's literally like there's zero supply coming online. My kid calls this the what's the game that they not Roblox, but
Is it Minecraft?
Minecraft. This is the Minecraft chart, and it does look like it. But this is the number of, if you were to take up not just Transocean, but Transocean has consolidated a massive amounts of companies. Transocean, Valaris, and all of their predecessors, like Global Marine and Falcon Drilling and Reading and Bates. These were massive offshore drillers back in the day, much bigger than what Transocean is today. But this is the number of rigs under construction. And I believe after Transocean and Valaris have brought on these latest couple, like there's nothing in the pipeline. Absolutely nothing in the pipeline. And why would you? They're like, estimated to be over $1 billion a ship. No one can justify that at these sort of day rates. But, this is what you're talking about. And, I am a Star Wars fan. So when Obi-Wan said now the Jedi are all but extinct, it's pretty much now the offshore fleet is all but extinct. And this the offshore fleet going back to 1956, just straight up number of boats. And I don't distinguish, at least in this chart, between jackups, semi-subs, drill ships, or ultra deep water, because at one point jackups were the deep water, ultra deep water. But with Diamond, Do, and Noble, forming, you pretty much got three. Maybe people always ask me, why don't you include
3.5 for Seadrill?
Yeah, it's like, like each, you'd be surprised how. It's because I haven't gotten the annual reports yet and haven't counted the boats yet. That's why they're not in this chart, but it wouldn't change the conclusion. But the consolidation is real. It's happened. It's going to continue to happen. But day rates are starting to perk up here. If you just take the average reported day rates now, some of this people are going to say 270, but this is their average, so it does include a lot of shallow water stuff. And the averages pays all the bills, right? Not just ultra deep water for some of these names, rigs above everyone else because they shed a lot of their shallow water assets, but it is starting to perk up. And what's the potential for offshore drillers? Well, it's massive. It could be massive. If you just say plug in 30 to let's just say 30 to 40% EBIT margins on your model, whatever it is. I personally don't model anymore because I don't have to. There's massive earning surprises out there, and that's where margins have tended to peak every cycle for these guys. And I see no reason why they can't do that again now over the long run. Now, the interesting thing is that I will say, counter to this whole, bullish thesis. Actually, I wonder if, no, I didn't include it. Counter to this is I would actually, a lot of my content is going to be talking about this year about incentive structures, like what we talked about with the oil MPs. Is I wish they had better incentive structures right now. If you look at a lot of these guys, they compensate on EBITDA. Okay, just grow EBITDA. Well, if you actually look at it, EBITDAs, they can report EBITDA and adjusted EBITDA as positive, but the cash flows aren't. You know what I mean? And why you could see it in this previous chart is that's why EBIT margins are pretty much zero, is because all the EBITDAs in the DNA, it's non-cash, right? There's but they're getting compensated on that. I actually think, just like every other sector in oil and gas, they should be compensating on returns on capital, because that's what drives the stocks over the long run. You have Transocean on the left, as well as some major players from days past, Global Marine and Global Santa Fe. The blue lines is just NOPAT ROCE, or returns on capital versus EV to capital employed, and that's what drives the stocks over the long run. Yeah, I've done this versus EBITDA. It's not the same. So, but if I were to show you from 78 to 81, these drillers went up 5 to 6x, and the best time to own Transocean and Ensco, which was a predecessor to Valaris, was 05 to 08. So it's the last part of the cycle is the best time for these guys.
Interesting. As far as day rates, I think longer term, they obviously kind of have to gravitate higher, but what kind of day rates do you think we have to see? I guess let's focus in on deep water, since we kind of talked about the new build cost. Where do day rates have to go before you start seeing someone decide, hey, let's build one or two of these things, because they are expensive?
Oh, I think Judd on I forget what he runs. He's done some great work on this, and he's done a lot of podcasts sharing that.
Yeah, he was on the podcast earlier. It's I think his firm is Lake Cornelia Research.
Yeah, he's gone really into the weeds, and the great thing about him is he's shared a lot of his thought process around it. So I would sort of default back to him. You are seeing day rates in at least the ultra deep water and north of 550. And, that's good. But someone like a Transocean has a lot of underutilized assets still, right? They have a lot of underutilized, what is it?
Dry stack and cold stacked, yeah.
Yeah. So but the interesting thing about these cycles is, and what drives them up to these old highs of 30 to 40% EBIT margins. And I've examined this. This happened in the 70s. This happened in this little 98 cycle was a South America, Venezuela led cycle driven by barges, a drilling rig on a barge. And this 2000 cycle, what drives these is not the high spec stuff. The high spec stuff actually always stays utilized. If you look through all these annual reports, it's actually the old stuff that has to get brought back. Okay. So how high do day rates need to rise? Until Transocean can get an order for some of its North Sea assets, right? Until it can get an order, better day rates for some of its semi-submersibles. I mean, that's what I'd sort of be looking. It's sort of in shales, we talk about tier 2, tier 3. I guess it'd be like in offshore, you talk about the tier 2, tier 3 fleet.
Interesting.
Yeah.
Yeah. I think it's definitely one to watch, but it'll be, like you said, it is interesting to think about it as kind of that last third wave type of asset as far as oil goes. But I could show you the charts on Global Marine here, and you can sort of see it in this chart.
But, the cycle got kicked off in, well, I'd say 1970, but you can see from 70 to 78, the stock just driven by EV to capital employed, it went nowhere, absolutely nowhere,
Yeah.
And it wasn't until from 78 to 81 when not just the high spec stuff, but some of the older jackups started getting used. I mean, there was some stuff where like 50 feet, like I've read the annual reports, assets that can only go up to 50, 75 feet were getting day rates that like the ultra deep water stuff was getting 2 years ago. It was amazing. And then you can even see it here in Transocean from 98 to 05. It was sort of a dud. And then you can bring up the old charts, 05 to 07. It was just an absolute rock star, but it's compact,
Yeah. Interesting. As we're kind of wrapping up here, there are a couple big picture questions I think would be interesting place to wrap up, which I'd say the last year, a lot of people I've talked to, like the boogeyman in the room is OPEC spare capacity. And there are people that are basically saying, I mean, they've been saying it for almost a year now, but they're going to come back, flood the market, and it's like going to be all over. And they've got, some people say it's 5 million barrels. Other people say it's 3 to 4. Do you have an opinion on OPEC spare capacity, if and when they might be bringing that back?
The funny thing is that, and I've been guilty of it, but if you rely, what do you think OPEC spare capacity looked like from 70 to 81?
I would have to punt on that question. I have no idea. So
up or down?
I would say,
I mean, prices rose 10x.
Yeah, I would say it. I guess up. I mean,
so one of the most bullish cycles in oil for this period here, OPEC spare actually rose by a factor of 3x. Yeah. So, and it's like, oh, okay, well, yeah, they took supply away. Well, they're withholding supply again, and I think OPEC spare capacity, there's things that I consider as drivers. There's things I consider as part of the narrative. And within my bucket, OPEC spare capacity is sort of part of the narrative, particularly the narrative within that sort of optimism, parabolic euphoria stage. Like, for example, the cycle got kicked off here in 98, but OPEC spare capacity didn't really start declining until it was about halfway into the cycle, into the 2000s. And in my opinion, OPEC spare capacity looks pretty much the same as like a dollar chart, which in and of itself is just telling you of the weakness that we've seen in EMs and the flood of capital that's flying into the US right now to fund this AI boom. So I know the bears were out in full force in the back half of 24, and it was actually quite interesting to watch because of the headlines that were hitting things like the Financial Times, but they said they were going to flood the market, but there was actually it never happened. And it never, in my opinion, will it start to happen? Yeah. Will they want to, flood them or come back, bring barrels back on supply, especially if these things with Iran happen? Yeah. But I think the long-term drivers of all this is what's happening within non-OPEC, and particularly of those things that we talked about around well productivity and development costs.
Yeah, interesting.
So will the barrels return? Yeah, but the problem I always have with it is sort of the same problem that I had when we were talking about supply and demand, is that if I can't contextualize it and prove it in a chart with a lot of historical data, then it just doesn't make sense to me. And I've done numerous charts on OPEC spare capacity as percent of demand versus prices. And there's periods when it works, and there's a lot of periods when it doesn't work.
Interesting.
Yeah.
So to move on to the non-OPEC side of things, the other thing that I think will be interesting to watch is what's going on in the Permian. Do you think that 2025 is the year that like the Permian starts to roll over as far as production, or do you have an opinion there as far as
Yeah.
like actual production levels?
Yeah, I think everyone wants to see it roll over, but it may not roll over ever. You know, the sort of going back to incentive structures, right? Is that one of the biggest changes over the last 10 years in incentive structures is companies incentivize CapEx controls a lot more now than they did 10 years ago.
Mm-hmm.
And they incentivize it, but we've seen production rise. So what they did is companies and boards incentivize the productivity boom that we've seen, right? More production with less rigs, less input, less frac crews. It is, to those who were paying attention, it was just there in the incentive structures. And so will the Permian ever roll over? I don't think so. And I don't think it'll ever be, as far as just barrels, sort of rolling over, is because you always want to be careful when an industry is sort of up against its back against the wall. It just figures out how to get very darn efficient with what it's got. Okay.
Mm-hmm.
You always got to be careful of the ones where excesses have built up. That's where the waste is. And within oil and gas, there hasn't been a lot of excesses the last 10 years. So what I think has happened is, and I showed that earlier, is the productivity growth, like the change in the year-over-year change has rolled over, but that doesn't necessarily mean that production is going to roll over. I was just at a very wide industry conference a couple weeks ago, and to hear the terms like lean manufacturing and Six Sigma get thrown around among these E&Ps, they weren't using these terms 10 years ago. It was strictly find it, develop it. Now it's a manufacturing process. It's more akin to, the old school, like GE black belt lean manufacturing. It's like these guys are always going to find a little bit more productivity, but just the rate of growth that they did the last 10 years versus the forward 10, it's not going to be the same. And it hasn't been the same. Even some of these companies are drilling 4-mile laterals is the new talk of the town. And there's even some doubts about being able to maintain frac pressure in the toe, which is the farthest end of the 4-mile lateral. It's all the way out here, right? There's even doubts. I've seen some great research from my buddies over at Flow with what Exxon's throwing out there. Some of their with their new proppant, some of it maybe doesn't have great results in some of the deeper basins within the Permian. So remains to be seen.
Interesting. If people are interested in finding some of your work, where is the best place to find you? On Twitter, but obviously you're on Substack.
Yeah, you can find me on Twitter. This is my contact info. The best place, you can just Google me. I'm finally ranking #1 on Crude Chronicles. It used to actually be this book about indigenous. I'll let you look it up. But I finally got the #1 spot. My website is thecrudechronicles.substack.com. You can find me on Twitter at Crude Chronicle, and that's also my email address. And thanks, Ben. I enjoyed this talk, man.
Yeah, no, I'm sure people will get a lot out of it. But before I do let you go, I do have to ask my traditional closing question, which is, what book should I add to my reading list?
I got a lot. What do you have a topic?
Can be history, finance, investments, whatever.
Yeah, I'm just sort of looking at one of my bookcases over here on the left. I've been lucky enough to, gotten to meet a gentleman by the name of Doug Terreson over the last couple years. If you don't know him, he's pretty much like the GOAT in not only on the sell side research side of things in the oil and gas world. He's been around the industry a long time. He recently published a book, Can't Deny It, and which was sort of a biography of his journey on Wall Street. I think for anyone in this space, it is like a little bit of a blueprint on how to think, not just think about this industry, but stocks in general. The Bible on the history of oil and gas, you can't go wrong with The Prize by Daniel Yergin. I've probably read it 8 times. And as of late, if you want to know about finance, I think one of the best finance books I've ever read is, it's by Stewart, The Quest for Value. I get a lot of my thinking from that. That's where returns on capital versus cost of capital makes its way into a lot of work.
Interesting. I'll have to add those to the list and eventually check them out. But I appreciate you taking the time to come on. I think a lot of people will get a lot of value out of our conversation. So with that, I think we'll be wrapping up. Thanks for stopping by. We'll see you next time.